As we sail into the latter half of 2024, the Canadian economy finds itself at a crossroads. Global headwinds fueled by geopolitical tensions and persistent inflation cast a shadow of uncertainty over the economic landscape. In these turbulent times, understanding the forces shaping our economic future is paramount. This essay delves into Canada's economic forecast for 2024, exploring the likelihood of a recession and its potential impact on individuals and businesses alike. Drawing upon my experience navigating the complexities of the global economy, I aim to provide clarity amidst the uncertainty, equipping readers with the knowledge to make informed decisions. Our journey begins with an assessment of Canada's current economic standing, examining the factors that contribute to both its resilience and vulnerability in the face of global challenges. Together, we will navigate the intricate web of economic indicators, deciphering the signals that point towards or away from a potential recession. Ultimately, the goal is to empower individuals and businesses with the insights needed to weather any economic storm and emerge stronger on the other side. By understanding the forces at play, we can chart a course toward a more prosperous future, even amidst uncertainty. Canada entered 2024 on a cautiously optimistic note. The economy had shown resilience in the face of global challenges, maintaining steady, albeit moderate, growth. The labour market remained robust, with unemployment hovering near historic lows, indicating a strong demand for skilled workers. Consumer spending, a key driver of economic activity, remained relatively stable, buoyed by pent-up demand and a strong housing market. However, cracks in the facade have begun to emerge. Inflation, while moderating somewhat, continues to erode purchasing power, putting a strain on household budgets. The Bank of Canada's efforts to tame inflation through interest rate hikes have slowed economic activity, particularly in interest-sensitive sectors like housing and construction. The once booming housing market has cooled considerably, with prices softening in many regions. Globally, the economic outlook remains uncertain. The ongoing conflict in Europe, coupled with supply chain disruptions and slowing growth in major economies like China, continues to weigh on global trade and investment. These external factors cast a long shadow over Canada's economic prospects, underscoring the interconnectedness of the global economy. In this context, understanding the likelihood and potential impact of a recession becomes crucial. The following sections will delve into the factors that could tip Canada into a recession, the warning signs to watch for, and the potential consequences for individuals and businesses. The question on everyone's mind is whether Canada is heading for a recession. While predicting the future of the economy is an inherently uncertain endeavor, several factors suggest that a recession in 2024 or 2025 is a distinct possibility. The Bank of Canada itself has acknowledged the heightened risk, citing a number of headwinds facing the economy. One of the most significant risks stems from the aggressive interest rate hikes implemented by the Bank of Canada to combat inflation. While necessary to curb rising prices, higher interest rates act as a drag on economic growth by making it more expensive for businesses to invest and for consumers to borrow money. This can lead to a slowdown in spending and investment, ultimately pushing the economy towards recession. Another concern is the potential for a sharp correction in the housing market. House prices in Canada have soared in recent years, fueled by low interest rates and strong demand. However, with interest rates now on the rise, affordability has become a major concern. A significant decline in house prices could trigger a negative feedback loop, leading to reduced consumer spending, job losses in the construction sector, and a broader economic downturn. Furthermore, the global economic outlook remains uncertain and volatile. The war in Ukraine, coupled with ongoing supply chain disruptions and geopolitical tensions, continues to pose significant risks to global growth. A slowdown in the global economy would inevitably impact Canada, particularly through reduced demand for exports. While these factors paint a concerning picture, it is important to note that recessions are not inevitable. Canada possesses a number of economic strengths, including a diversified economy, a strong financial system, and a sound fiscal position. These factors provide a buffer against external shocks and could help to mitigate the severity of any potential downturn. Before delving further into Canada's economic prospects, it's essential to understand what constitutes a recession and the potential consequences. In simple terms, a recession is a period of significant economic decline, typically characterized by a contraction in gross domestic product for 2 consecutive quarters or more. This contraction is usually accompanied by a range of negative economic indicators such as rising unemployment. As businesses face declining profits and reduced demand, they may be forced to lay off workers, leading to a rise in unemployment. Falling consumer spending, with job insecurity and economic uncertainty looming, consumers tend to tighten their belts and reduce their spending, further dampening economic activity. Declining investment, businesses become hesitant to invest in new projects or expand their operations during times of economic uncertainty, leading to a decline in investment spending. Falling asset prices, stock markets typically decline during recessions, reflecting investor pessimism about future corporate profits. Real estate prices may also fall as demand weakens. Recessions can be triggered by a variety of factors, including economic shocks, sudden unexpected events such as a financial crisis, a natural disaster, or a pandemic can disrupt economic activity and lead to a recession. Asset bubbles, when the prices of assets like stocks or real estate become inflated beyond their intrinsic value. A sudden burst or correction can have severe economic consequences. Policy mistakes, government policies such as excessive regulation or poorly timed fiscal or monetary policy decisions, can also contribute to recessions. The consequences of a recession can be far-reaching, impacting individuals, businesses, and the overall economy. Recessions can lead to job losses, business closures, increased poverty, and a decline in living standards. They can also strain government budgets as tax revenues fall and demand for social services rises. Understanding the causes, characteristics, and consequences of recessions is crucial for policymakers, businesses, and individuals alike. It allows for informed decision-making, risk mitigation, and proactive planning to navigate economic downturns.